Ladies and gentlemen, welcome to Entrepreneurial Finance, a definition of venture capital. What is venture capital about? Let's look at typical venture capital companies. And this is two examples of venture capital companies. First of all, DAG Ventures. DAG typically invests in expansion phase companies, so not very early, but still early, which already received initial financial support from top venture capital firms or business angels. So what they basically do is they jump on a bandwagon. They look at companies who have some track record, who have first investors, and who jump on this investment, invest in later stages, not still early stages, but for the early stage, if you want to differentiate that, the later moments, so to say, and try to make their returns too. I mean, they have to pay more for these investments. However, the failure rate is probably a little lower, and this is also why they can, for example, be a little more diversified, because the only thing they have to look at is track record and other good investors who are in these companies before. If they let DAG in, this is always a question. On the other side, we have Excel Partners. Excel Partners, they are a typical investor of first come, first serve. They invest in very early stages. They want to be the first institutional money into startups. So after the entrepreneur, the 4Fs, the business angels invested, they want to be the next investor. And this is their approach to investing. So buying very early, buying for a very low price, however, having a higher uncertainty in these investments, and so they have to focus more in order to at least reduce some kind of uncertainty or information asymmetry through their knowledge. And they want to be in the board seat because they think they have to influence this company a lot more than DAG, because they don't require a board seat. They said if the company is up and running and is going to be successful and we go in at that stage, we do not need to influence that a lot more. But there you can also see that venture capital is probably about money on the one hand and about some kind of influence, some kind of support on the other hand. And this is a good definition to some extent on venture capital. Because venture capital, first of all, is equity capital in most cases. Maybe there is some debt capital involved, but only in order to put in convertible debt or to make the valuation a little sweeter in early moments, whatever. But this is mostly equity deals or only equity deals, because this is the only way to cover for losses on the other side. Secondly, not only financial resources, it's also management services. So if you consider a company, or if you look at the company just being brought up, being founded by a young entrepreneur, a Harvard dropout, you have to look at this person a little closer and have to look what he's able to do and maybe what skills he's lacking. And these skills you might want to bring in. This is what business angels do, but this is also what venture capital does. Provide some management services, provide network, provide access to markets, access to people, and so on. So also very typical in early stages where you have an owner-manager dominance. You do not talk only about money, but also about additional support. And it is a long-term investment, or at least long-term to that extent, that it is 3 to 7, 4 to 8, whatever years, and the return is being done by capital gains. Most of these companies aren't making money at the very beginning, negative cash flows over the years, and maybe turn break even after 30, 40, 50 months. So the main business model of venture capital is buying low, sell high, investing in early stages for a comparably low valuation and selling for a high valuation. Selling a WhatsApp for $19 billion gave Sequoia Capital also a couple $1 billion, and they bought it for a lot less. This is the business model. And there's a couple venture capital firms out there also in Europe. You have the European Founders Fund, for example, with these former entrepreneurs who have the venture capital vehicle right now. You have 3i from England, very, very popular venture capital firm, but you also have corporate venture capital out there. So corporates who put venture capital in young startups in order to technology developments. So basically they have a focus on high growth companies, very young companies, early stages where you can buy low in order to sell high later on. They invest equity, and this is what we said, with high risks. You better call it uncertainty, and it's built on capital gains and active involvement by the venture capital partners. If you look at some numbers, you can see that, and this is the example of the US, the venture capital is quite popular. I mean, about $30 billion invested into 2013, which is quite an amount, into close to 4,000 companies. So you can see that venture capital plays a role in the economy and is very important for the emergence and the development of entrepreneurial firms. Without this money, without these investments, these companies might not be able to survive, or at least might not be able to show the growth rates they are having. On the other hand, if you look at venture-backed exits, you can see this is for sure a lower number. You can see that we have a pretty stable number of M&A deals over time, 377 2013, a couple more in 2010, less in 2009. And right now you have some more IPOs. So if you sum that up to a number, it is in close to 400 in 2009, close to 400, 450 in 2013, where you can also get some idea of the ratio. So if you look at this approximately 450 there, and look back, let's look back a couple of years, maybe from 2009 to 2013, which will be 4 years of investment, a little too low investment period. You have a ratio of 15% of deals that are in an M&A, that in a sale process, IPO or M&A process. So there you can also get a little feeling about the business model of a venture capitalist. They invest in startups, they invest in uncertainty, and some of these companies get successful. Maybe 10, maybe 15, maybe 20%. But in most cases, also at least 50 are bankrupt, are out, and there's still, in the other 50%, there's some living dead companies that survive, but are dead for the venture capitalists. So venture capital basically has to make the return with about 20% of the investments, so 2 out of 10. And this is the deals they're looking for. If you invest, you always consider the one deal as the most important one. However, in the end, it's only 2 out of 10.